Good evening. Thank you again for attending this investor forum. So basically, I start with giving everyone maybe an introduction about the sustainable investing. Okay, so when when investors and regulators and the various stakeholders, when we talk about sustainable investing, uh, there are some different concepts or definition of that. Uh, if we look at the EU Commission definition, we can think of sustainable investing generally as referring to the process of when you are making an investment, you want to take into account the environmental, social consideration, and the objective or the long-term objective is that when you are making such investment, this will basically be so-called good or sustainable for the environment. And if you look at the chart, when you think of this notion of sustainable development, there's actually kind of like three components to that. So you have environmental, which is a very major issue, and under the environmental umbrella, you have various strategies to try to mitigate the global warming. So for those of you who have attended the corporate governance conference on Monday, the speaker talked about, for example, some of these climate change mitigation as well as climate change adaptation strategies. So essentially, we basically hope that the entire world recognize that we are living in a we are basically a global community whereby we want to ensure that a standard of living that does not so-called destroy the next generation kind of standard of living. So there's this awareness or understanding that we should not, for example, say, use up all the resources, the natural resources in this earth, such that the future generation do not have sufficient resources. So that's the E part of sustainable development, and of course you have the social as well as the economic or the governance. So this is how they coined the term of ESG. Okay, so E basically stands for environmental, and under environmental, we are looking at things such as greenhouse gas emission, energy management, water management, waste management, so on and so forth. As increasingly getting important and in some way, lots of different views. So under S, some of the social issues, things like diversity, inclusion, sometimes they go by acronym of DEI, and some people make fun of that DEI and call that DIE. Okay, they swap the E and the I. And apart from diversity and inclusion and equity, you also have things like customer privacy, data security, so on and so forth. So that's the S of ESG. And finally, for G, you have basically corporate governance, which is for SIAS, this week is the corporate governance week. So we are talking about things like business ethics, we're talking about business model resilience, risk management, so on and so forth. And when you think of this ESG paradigm, essentially what they are trying to address is the various corporate sustainability issues. So under environment, of course, we're talking about decarbonization, and increasingly also this notion of biodiversity. So the recognition that there are so many species, both the animal as well as plant species, which are being made extinct, and what happened is that when that happened, there's a permanent loss, okay, for the environment. And under S, of course, you have human rights, you have labor rights, health and safety issues. Increasingly important too is the notion of access and affordability, especially with inflation in the last 2 years. This concern of whether do people have sustainable income. And finally, of course, under economics, we talk about business ethics, we talk about reporting, legal compliance, tax transparency, so on and so forth. So if you think of this entire ecosystem, sustainable investing ecosystem, is actually made up of many different areas. So you can look at it from the angle of who is providing the capital, the investors, public finance, perhaps from the government. And for the financial services provider, of course, we have the banks, insurance company, fund managers, so on and so forth. And when we look at the various investing instruments, can think of green finance. So that would be the green bonds, sustainable bonds. We can think of things like ETF, sustainability team ETF, and various fund managers coming out with different kind of sustainable fund, like let's say the EV, electric vehicle. And as what I mentioned, earlier on, so the intention is for this investment to be able to generate a longer term sustainable economic activities. So that's kind of like the big picture of sustainable investing ecosystem. And the history of sustainable investing is something which has developed over the years. So, back in, let's say, if you look at this timeline, this is just an example of some of the major events that might happen over the years. Let's say from 1987 all the way to 2020s. So, as we look through this timeline, we find that there's, over the years, you have many NGOs that have, being formed in a way ground up. That means to say that it's not top down, it's not from the government. So you have things like GRI, for example. GRI is one of first NGO to look at sustainable reporting. You have other organizations, TCF, SASP, so on and so forth. And over the years, they basically try to, from their perspective, they want to, modify or change what we call traditional finance or traditional investing, which is just looking at risk and return. How much, how much return you can get, and how much risk you're taking, when you make such investment, to a more bigger picture of taking into consideration environmental factors as well as some of the social factors. So as mentioned, earlier, you have this huge ecosystem, and you find that for companies, of course, you have all these various stakeholders, not just the shareholders. So you have employees, you have government, you have the various NGOs, and for companies these days, increasingly they have a recognition that they want to be a good corporate citizen. So the notion of who or what's the function of companies? Do they just serve the shareholder interests, or do they have a society function or role such that go beyond just simple dollar and cents and profitability? So what happens is that if you have a CEO and the CEO is being compensated, okay, let's say by you know, how much earnings per share, how much earnings performance, how much earnings growth, for example. Then inevitable for that CEO, the P&L is what will matter to him a lot. And for in such a context, when the CEO is looking at sustainable activities, then at the top of his head, he'll be thinking about how much would this cost my company? Because essentially, if you look only at just the P&L, if you do not consider other externalities, then what will happen is that let's say if the company decide to have a sustainable initiative and that costs $100,000, well, the implication, the accounting implication is that the reported earnings for that year will go down by $100,000 because these are regarded or classified as expenses. On the other hand, you find that increasingly, partly because of social media, because of employees who want to work in companies which are socially desirable. That means companies that have a larger social agenda beyond just making money for the shareholders. So there is greater sensitivity that when you look at what a company is doing, they are more careful that it's not just purely dollar and cent or purely profit. So in that context, when you have ESG investment, you have sustainable investing, companies have the opportunity to be seen as doing some social good, not just mindlessly chasing higher profit and nothing else. So in this context, the agenda for companies go beyond just profit, and can think of it as the various circles that we have. Okay, so you have at the top, you have, for example, managing risk. So in companies, some companies, they have, for example, a risk management committee. And if you look at the different aspects of risk, in other words, things that might have harmed the company or might cause the company to become unstable. So right now, if you think of in the context of ESG, you have climate risk. And essentially, if you look at, for example, say TCFD, they will classify the climate risk into two categories: the climate physical risk. So, for example, you might have a typhoon or an earthquake, or sea level water rising, okay, which will destroy assets, and cause damage to properties. So that's climate physical risk. And there's climate transition risk, as the economy transit towards a low carbon economy. So there might be some risk if, for example, say, if a company is not forward-looking and insists on, let's say, just using traditional motor vehicles. And perhaps, let's say the government, as we know, the government have announced, for example, say by 2030, we're going to have more of the EVs, electric vehicles. So will a company be able to successfully transit from, let's say, their traditional way of doing business to a more greener kind of growth? So that's something which companies have to look at or think about in terms of risk management. In terms of staff attraction or retention, so I mentioned a little bit about that. So I think especially when we look at some of the younger generation, the Gen Z and all that, they have certain views or opinion or their way of thinking. And very important for them is they want to be seen as kind of they want to be seen as being cool, or they want to be seen as you know they do not want their peers to laugh at them. Okay, so the classic case, and because I'm in this accounting profession, which the classic case is that in the past, let's say 20 years ago, when I was more than 20 years ago when I was accounting undergrad, you know, it was viewed as very prestigious, you know, to go to an accounting profession, to join the big four audit firms, you know, something which is not easy. And these days, if you ask some of the younger, my students, for example, some of them, they will, they might not think otherwise, you know, similar to, you know, my days when I was an undergrad. So peer pressure play a part. So in other words, if you have two companies, company A and company B, and both have, let's say, the same level of profitability, and both have the same level of, you know, everything else equal. But company A is being viewed as, let's say, socially undesirable or environmentally unfriendly. And company B, on the other hand, is like, it's very popular. You know, people, when people think of company B, it has a very good reputation. You know, it does all the you know, it does all the right things and say all the good things. And society have a high or, you know, positive opinion of company B. And you find that younger generation, they want to work in an organization or company that have such positive attributes. So that's something which, you know, again, a factor to be considered, you know, when we look at going beyond just, you know, pure dollar and cent. Okay. So other factors that also are important, you know, some of it we mentioned it, you know, regulatory compliance. So in the Singapore context, we have the Green Plan 2030, and you know, this notion of when we look at the environment, okay, basically how can we contribute to you know, positive climate action and sustainability. This is in terms of kind of like what have happened over the years. So the between, let's say, Asia and, you know, the European nations, you find that in some way the EU, the European Union, they were the kind of like the first mover, okay, in setting the foundation for sustainable investing, sustainable finance. So back in, you know, 2018, for example, that's where they have some of frameworks, you know, such as the sustainable finance disclosure regulation, and many of the NGOs, you know, GRI, for example, originated from the EU too. So in that context, they are seen as the kind of the forerunners of this sustainability initiative. And Asia, in some way, we sometimes, you know, people say that Asian companies, they are more concerned or more interested in just the bread and butter issues, you know, and sustainability reporting sometimes being viewed as an onerous requirement, you know, because it would cost money, right, to employ staff, you know, to change the systems in the company to, you know, to adapt to you know, reporting or to adapt towards producing, let's say, a sustainability report, which is not an easy exercise. So in that context, you know, I think the various European countries have done pretty much a very good job of laying down the foundation for sustainable finance and sustainable investing. And some of the things that they have done, okay, you know, this is like kind of like you know, various things that they have looked at, or they have you know, initiated, you know, but basically is to increase awareness, understanding, as well as to basically look at how, let's say, we can reduce greenhouse gas emissions. And right now, unfortunately, if you look at, you know, kind of the direction towards, so basically we are very close towards the 1.5 degrees Celsius threshold, and I think based on projection, in just a matter of just a couple of few more years, I think we will just hit the 1.5 degrees Celsius threshold. And thereafter, once that threshold has been breached, the next, we'll be looking at the 2 degrees Celsius threshold. And, when that happens, of course, you're going to experience, higher temperature. And after 2 degrees Celsius, people are looking at 3 degrees Celsius. If we go up to 4 degrees Celsius, I think, it's basically like a doomsday kind of scenario for that. So when you look at what has been done, again, this is some of this material is actually way more than 30 minutes presentation. But essentially, the thrust of this is that the finance sector has a major role to contribute towards sustainability. So what this means is that if you look at, for example, say the investors. So in traditional finance, CEO are answerable to the investors. And if the investors just care about how much, let's say how much dividend I'm getting, or how much share price appreciation, then of course, the CEO would likewise be looking at such financial goals. And thankfully, that's not the case. And what I meant by that is that, in the past few years and even as of today, there's big investors, institutional investors, big private investors who ask questions to their CEO during like AGMs and various other meetings, for example, and they basically or some of these investors basically want the company to go beyond just the financial returns, and because they are aware that some of these companies are already big. They're talking about some companies are basically like in terms of their market cap, they can go into billions of dollars or even trillions of dollars. So these companies can play a major role in deciding, for example, if they look at their value chain, are they going to use, let's say, sustainable packaging, which might cost a little bit more than conventional plastic bags? So, this is just one example of things which companies can do differently. And so, from the perspective of the investor, okay, and this is where you have the term or the concept of responsible investing. So responsible investing in a way, overlap with sustainable investing in some ways. The notion of you want to incorporate ESG factors into your investment decisions. And for when we look over the years again, how much people care about the environment, you find that there is a strong momentum of investors going beyond just the financial dollar and cent profitability. And basically, there are many fund managers, investors, okay, who believe that if we do not care, for example, about the environment, let's say by 2050, then we might, really have a big crisis. So, and this is a good thing in the sense that when people think about, how much they want to invest and basically what, where to invest, the notion of ESG investing. Okay, so on the one hand, and this is actually a big debate kind of thing. So you have people on both sides. There are people who advocate ESG investing. Everything should be green investing, or everything should be you should consider or take into account the environment and so on and so forth. And on the other hand, there are also investors who say, don't care about all these green things, and their primary consideration is, the financial returns, or would investing, let's say, in a company or green investing, would that lead to lower returns? There are various studies that have looked into this issue. This is one example of a study that show that if you invest in these what we call companies that have very high ESG ratings, that means like those companies that care about the environment, social issues, they have outperformed the normal the so-called the MSCI index. Okay, so the ESG leaders outperform the MSCI index, the average company in the MSCI index. So that's one example of that. And another case is that this notion that for the high ESG performance, because they look into the various, the environment, social, governance, so they are being perceived as a company with lower risk, which if you are an investor, you prefer to invest in a company that have so-called lower risk. Everything else equal, of course. So I think in conclusion, if you, given the way that you have global warming is not going away, so likewise with sustainable investing, I think it's not something which is like, good to have, and then I think sustainable investing is also not going away. And climate risk is, maybe your experience, higher temperature is a real thing. And for society, for companies, there's a need to set net zero goals. And thankfully in Singapore, we have the government has set up ministry, right, for sustainability, and we have a plan 2030, and the government is very far-sighted. For example, because we are an island nation, so one of the big climate risks is rising seawater, and the government have really budgeted, for resources, a long-term plan over 10 years, to ensure that we will not, if and when sea waters were to rise, Singapore would not be submerged into that. So so I think in conclusion, basically, for some companies, they view ESG compliance as a reporting burden, but in some ways it's like a good thing to have. It's like, if I may to use an analogy, an imperfect analogy, it's like eating your vegetables, right, which are green. Some kids or some adults even prefer just to eat meat, for example, which is maybe not so sustainable. But eating vegetables is good for a person's health, it's good for society, it's good for the environment. So so in that context, that's my so-called presentation on giving you guys an introduction to sustainable and green investing. Yeah, thank you.